Realty Income is currently trading at $52.47, and over the past year they are down by 10%, and over the past 5 years they are down by 30%, currently trading very near their 52-week low. So jumping straight to our stock valuation spreadsheets, let's figure out if this dividend aristocrat is currently in buy. Now right away we can see their very sweet dividend yield sitting at almost 6%. Now, if you are anything like me, you are investing so that one day you can retire and live off of dividends, not having to rely on your assigned pension. So that's exactly the perspective from which we will value Realty Income. Are they a good enough company that will in 20 years or so allow you to live off of dividends? Now, what you have to understand is that high dividend yield isn't everything. If you want to one day live off of dividends, you need to invest into companies that have steady high dividend growth. So jumping straight to our dividend tab, we can see that O has a 5-year dividend growth of 2.75%, which is below the average of 4.13%. But jumping back to Seeking Alpha and moving to the dividend yield tab, something we also have to consider is how high the current dividend yield is compared to the historical dividend yield. Because if you invested into Realty Income 10 years ago, the dividend yield back then would have been about 4%. So if we scroll down to the yield on cost tab, you can see that your yield on cost would be 5.84%, which is actually lower than the dividend yield you would have if you invested into the company right now. And so investing into a company when their dividend yield is very high compared to their historical dividend yield might pay off, because your dividend yield on cost might skyrocket within a very short period. So within 10 years, your yield on cost might be more than 10%. So if you invested $10,000 in 10 years, you would be making $1,000 in dividends every single year. So their dividend growth might not be as attractive, but their high dividend yield certainly is. But let's jump back to the 9 pillars and have a look at some of the other metrics of the company. We can see that O gets a rating of 6 out of 9, with 3 pillars currently in the red. And so first let's have a look at the profits growth of the company, which is the main driver behind their stock price growth. We can see that their revenue has been growing at a rate of about 28% yearly, their FFO has been increasing at a rate of 32% yearly, and their net income has been increasing at a rate of 31% yearly. Now, if we have a closer look at these 3 metrics, we can see that the revenue rose from 1.5 billion in 2020 to 4 billion in 2024, and year over year it grew by another 22.8%. Regarding the net income, that has had a big jump from 2022 to 2023, but in the past 3 years it actually hasn't grown by that much. And finally, moving to the FFO, so funds from operations, that has also had a big jump from 2022 to 2023, and since then hasn't moved much, but year over year it grew by 16%. And if we scroll down, we can see that there actually has been an increase in the FFO per share, increasing from 3.36 in 2020 to 4 in 2024. And this brings me to my next point. If we jump back to the 9 pillars, we can have a look at the decreasing shares outstanding. And Realty has actually been increasing their shares outstanding at a very high rate of almost 22% yearly. So zooming into pillar 7, we can see that the company has actually increased their shares outstanding by more than 100% over the past 5 years, which isn't great, as now they have to pay out twice as much FFO in dividends. Now, the reason why this doesn't bother me that much is if we jump back to pillar 5, we can see that the FFO per share has been increasing. So even though they have been increasing their shares outstanding, their FFO, as we know, has been increasing as well. So the intrinsic value of the company hasn't actually been falling, but it has been increasing quite steadily. The one thing I do find quite worrying about the company is their high debt levels. If we move to pillar 9 and look at the long-term liabilities over the 5-year FFO negative dividends, we can see that this value is sitting at 13.62, while we want it to be below 3. And this essentially means that with the FFO they currently generate and with the dividends they currently pay out, it would take them more than 50 years to pay off all their long-term liabilities. Now, I wouldn't mind the ratio being this high if they were actually paying off their long-term liabilities, but if we zoom in closer, we can see that they have been increasing them at a yearly rate of almost 30.5%. Now, as Realty Income is a REIT, this could potentially be explained by most of the debt being long-term mortgages. But still, if you do want to add this company to your portfolio, make sure to do more research on the long-term liabilities. But now, jumping back to 9-pillar analysis, let's also have a look at the 5-year PE ratio of the company and the 5-year price to FFO. So first jumping to pillar 1, we can see that the 5-year average PE is sitting at 52.60 and the current PE is sitting slightly lower at 49.97, but that is still way above the average stock PE ratio of 22.5. But as Realty Income is a REIT, what concerns us more than the PE ratio is the price to FFO, which we can see is currently sitting at 13.35, which is lower than the 5-year average, showing us that the company would be undervalued compared to the FFO they have been generating in the past. So now let's calculate their intrinsic value compared to their historical price to FFO. So jumping to the historical price to FFO model, we'll take the historical price per share, the historical FFO per share, and calculate the historical price to FFO, which we will average out and compare to the current price to FFO and get an intrinsic value of $65.16, which is quite higher than the current trading price. Now let's also calculate the intrinsic value of the company using the discounted FFO model. So we'll take the funds from operations over the past 5 years and calculate the average growth rate to be sitting at about 32.39%. Now, as I do want to be conservative, I will calculate the future growth rate into the next 8 years plus of 9.3%, and using this I will calculate the future FFO. After that, I will plug in a discount rate at 9.4% and calculate the present value of that FFO. I will then sum all of that up, add cash and cash equivalents, and subtract total debt to get an equity value, which I will divide by the shares outstanding and get an intrinsic value of $54.92, which is practically spot on with the current trading price. Now I also want to compare Realty Income to 3 of its competitors, so SPG, Kim, and REG. We'll take these companies' current stock prices and divide by their FFOs per share to get their prices to FFO. We will average them out and multiply by the FFO per share of Realty Income and get an intrinsic value of $61.28, which is higher than the current trading price, showing us that Realty Income would be considered undervalued compared to its peers. And finally, moving to the dividend discount model, we will take the dividend payouts over the past 5 years and calculate an average growth rate of 3.01%. Now, as I do want to be conservative, as the company does have a lot of debt, I will project a growth rate of only 2.67%. And combining that with the discount rate, we will get an intrinsic value of only $46.70, which is lower than the current trading price. Now, moving to the ultimate valuation, we will average out these 4 valuation models and get an intrinsic value of $53.99, which is 2.9% higher than the current trading price. So basically spot on with the current trading price. And if we plug in a margin of safety of 15%, our acceptable buy price would be $45.89. Now, as I do want to be fully transparent, I currently do not own Realty Income in my portfolio, and if I was to buy it, I would buy it under our acceptable buy price of $45.90. And with that, if you did enjoy the video, make sure to let me know down in the comments if you are buying, selling, or holding Realty Income, and also make sure to leave a like and subscribe as it really helps me out.